Welcome back to Gold Rush Reporter, your go-to source for clear, expert analysis of gold and silver markets. I'm Conrad, and today we're diving into something crucial: the recent extreme volatility in silver and why it's shaking both industrial users and investors alike. If you've been watching silver prices spike and drop, wondering whether margin requirements actually matter, this video breaks it all down in a way you can actually understand. Let me ask you, are you holding silver right now or waiting for the perfect moment? Drop your answer in the comments. I'm watching this market closely, and what's happening could change how silver is traded for years to come. Stick with me, because by the end of this video, you'll understand why this is more than just short-term volatility. It's part of a structural shift in the silver market. First, let's tackle the big question. Do margin requirements actually stop this volatility? The short answer is no. Margin hikes may remove some weaker positions, but they cannot stop the bigger forces driving silver prices. End-of-year mark-to-market considerations mean that shorts want silver as low as possible to protect profits. This creates short-term downward pressure, but it's temporary, a speed bump, not a roadblock. Now, here's a critical concept: backwardation. That's when the spot price is higher than future contracts. In simple terms, people want silver now, not promises of silver later. And right now, backwardation is rising, especially in London, which is the hub for physical silver delivery. This is where the squeeze is really happening, not in COMEX, New York, which mostly signals paper trading. Industrial users are buying forward contracts and taking delivery, putting real pressure on available silver. Liquidity is extremely tight in London. Most silver in vaults is ETF owned and cannot be easily accessed, leaving only a small fraction available for industrial buyers. Estimates suggest around 150 million ounces exist outside ETFs, but much of that is already in firm hands. The result? Practically no free silver, which drives prices higher. This is especially important because industrial users cannot wait. Manufacturers of photovoltaic cells, EVs, and defense equipment need silver now. There is no wait-and-see strategy. Unlike traders, they cannot hedge or speculate. If they don't secure silver, their production lines stop. Another factor: the timing. The market is volatile at year-end when many industrial buyers are on holiday. Meanwhile, traders are balancing bonuses and mark-to-market accounting, which can exaggerate short-term swings. So, the sharp moves in silver are a mix of physical demand pressure and short-term trading behavior. Finally, we need to consider China. They're introducing a new export licensing regime, not to stop silver exports completely, but to gain control over domestic stocks. China is the largest refiner globally, handling silver along with copper, nickel, lead, and zinc. They understand the strategic importance of controlling these metals for industry, technology, and long-term supply security. Meanwhile, Western countries lack the refining capacity and electricity to compete. As we continue, let's zoom in on the London silver market, where the real action is happening. COMEX in New York is mostly a signaling hub for paper contracts, but London is the place where physical silver is delivered, and right now, the market there is extremely tight. Industrial buyers are stepping in aggressively, buying forward contracts and taking delivery, which puts tremendous stress on available inventory. The problem is that most silver in London vaults is ETF owned, which means it isn't freely available. Only a fraction of the metal is in liquid hands, and that fraction is quickly being absorbed by industrial users who cannot wait. This is why the term backwardation has become more than just a technical word. It's a red flag for scarcity. Liquidity in London is essentially minimal. Even though some analysts estimate roughly 150 million ounces outside ETF holdings, much of it is already controlled by companies and banks that are not willing to release it into the open market. So, industrial users are fighting over a shrinking pool of silver, and the situation is tightening by the day. The shorts in the paper market may push prices lower for a short period, but the physical demand is unstoppable. Companies in photovoltaics, electric vehicles, electronics, and defense are all competing for the same metal. If they don't secure it now, production lines stop, and the consequences are immediate. Unlike speculators or traders, these users cannot hedge by waiting for a better price. They need silver in hand. Another critical factor is the positioning of banks. The US banks, historically seen as dominant players in the silver market, are actually net long on COMEX derivatives, which is unusual for them. Meanwhile, foreign banks or non-US banks are structurally short, leaving them vulnerable. Normally, these banks hedge by holding long positions in London while being short on COMEX. But when industrial buyers demand delivery, the hedge fails. The metal that foreign banks expected to rely on in London is simply not available, intensifying the squeeze. This creates a real risk for paper shorts, because delivery cannot be faked when industrial users demand actual silver. The timing of this squeeze also compounds the volatility. Year-end mark-to-market pressures incentivize traders to push prices down temporarily, but these moves are short-lived. Industrial users, many of whom were on holiday during the late December period, suddenly realize they need metal immediately, creating a sudden burst of buying. This is why the swings in silver prices look extreme. It is not just speculation or algorithms, it is the market responding to urgent physical demand. China's influence is becoming more prominent in this dynamic. With its new export licensing regime, China is tightening control over domestic silver stocks without stopping exports entirely. China is the largest refiner in the world, handling not only silver but also copper, lead, nickel, and zinc. The country understands that controlling these metals is critical for its industrial and technological growth. Meanwhile, Western countries cannot compete due to limited refining capacity and electricity constraints, leaving China in a dominant position. They are essentially siphoning supply from Western markets, either by stockpiling or directly sourcing from major producers in Peru and Mexico. All of these factors together, the physical squeeze in London, minimal liquidity, industrial demand, the unusual bank positioning, year-end pressures, and China's strategic control, are creating structural stress in the silver market. This is not a temporary blip. It is part of a longer-term shift where physical demand increasingly dictates price, and paper markets become secondary. Understanding this dynamic is crucial for anyone invested in silver or watching industrial trends, because the combination of physical scarcity and strategic stockpiling is driving volatility in a way that simple technical analysis cannot explain. Now let's focus on China's role in the global silver market, which is increasingly shaping the supply-demand dynamics. China is not just a consumer. It's the largest refiner in the world, processing silver along with copper, nickel, lead, and zinc ores. This refining capability gives China a strategic advantage that Western countries simply cannot match. While the West relies on ETFs, futures contracts, and paper silver, China deals in physical metal, controlling the supply at the source. Their new export licensing regime, starting next week, doesn't stop silver from leaving China entirely, but it gives the government control over domestic stocks. By managing exports carefully, China ensures it retains enough silver for industrial use and strategic stockpiling. China's refining monopoly extends beyond silver. Rare earth elements, aluminum, and other industrial metals are tightly linked to refining infrastructure. While Western nations have closed or downsized many of their refining operations due to environmental or energy costs, China continues to invest heavily, giving it near total control over critical materials. This has huge implications for silver. Western investors and industrial users often assume there is free-floating metal available in London or COMEX vaults, but a significant portion is already locked up in ETFs or controlled by major players. The real, deliverable silver is scarce, and China is directly acquiring and storing it, bypassing traders and even refiners in the West. In addition, China has been buying directly from major silver producers in Peru and Mexico at above-market prices. This strategy, often called disintermediation, cuts out middlemen and ensures that a substantial portion of the world's silver supply is diverted directly to China, reducing availability in Western markets. Even when silver is exported from China, it's often funneled to financial centers like London, Singapore, or Switzerland, where it gets vaulted for later delivery. Meanwhile, industrial demand in Europe and North America is increasingly competing with this supply chain, creating tension between paper markets and physical reality. China's control also has a broader strategic angle. The country recognizes that silver is essential for renewable energy, photovoltaics, and EV battery production. Unlike investors who trade paper contracts, industrial users in China are locking in physical metal, ensuring they have the raw materials necessary for manufacturing and technology growth. This is a critical factor that many Western analysts fail to appreciate. It's not just about price or speculation. It's about securing the metal to sustain industrial activity. Meanwhile, Western reliance on paper markets is becoming increasingly problematic. COMEX and other futures exchanges primarily deal in contracts, not physical metal. When industrial users demand delivery, these paper positions cannot satisfy the real-world requirement for silver, creating a structural mismatch. This mismatch is amplified by China's actions, which are effectively removing a portion of physical supply from Western circulation. The consequence of this is clear. Backwardation, physical squeezes, and volatility will continue. When spot prices in London exceed futures prices on COMEX, it's a sign that physical metal is scarce and that the industrial users who need silver cannot wait for paper contracts. This is not short-term noise or trading algorithms reacting randomly. It's a fundamental shift in how silver supply and demand are balanced globally. China's behavior also illustrates why margins and paper market manipulation are increasingly irrelevant. Margin hikes may scare small investors or remove weaker positions, but the real action is driven by physical demand in Asia, by industrial users who cannot compromise on supply, and by sovereign and corporate actors taking delivery. The West may still debate volatility, but in reality, Asia is quietly absorbing massive quantities of metal, ensuring that physical possession matters more than paper positions. As we move forward, let's examine the industrial demand for silver and why it's creating a structural imbalance in the market. Over the past several years, global silver consumption has consistently outpaced mine supply, a gap historically made up by investment and increasingly by Chinese stockpiles. But now, industrial demand is accelerating at a rate that the market has never seen. Photovoltaics, solar panels, electric vehicles, and next-generation battery technologies are all swallowing hundreds of millions of ounces of silver annually. India and China are leading this consumption surge, but the ripple effects are felt globally, especially in sectors like electronics, defense, and AI infrastructure. Unlike investors or speculators, industrial users cannot wait for prices to drop. They must secure metal immediately, which drives one-way upward pressure on physical prices. Electric vehicle batteries, in particular, are a game changer. Some of the new silver-carbon battery designs require nearly a kilogram of silver per battery, not a few grams, as in older generations. If just 20% of new EVs adopt this technology, the silver demand from batteries alone would equal the entire annual global mine supply. Add to this the exponential growth in solar panel deployment, robotics, and AI-driven industries, and it becomes clear that silver is no longer a marginal commodity. It's critical infrastructure. Every ounce matters, and the paper market is struggling to reflect this reality accurately. Backwardation, the persistent situation where spot prices exceed futures prices, is another key indicator of this stress. When real metal is scarce and industrial users demand delivery, futures contracts cannot satisfy immediate physical needs. This isn't volatility or manipulation. It's a market signal of real-world tightness. In London, backwardation has been more pronounced than at any point in recent memory, signaling that the deliverable metal is in extremely short supply. The situation is compounded by ETF holdings, which are technically counted as part of available inventory, but are not liquid for industrial or hedging purposes. This means that despite appearances, the actual float of silver is tiny, intensifying the physical squeeze. Meanwhile, the paper market continues to play a role, but its function has shifted. COMEX and other exchanges are increasingly being used by industrial actors as a mechanism to acquire physical silver, not as a speculative playground. Around 15,000 tons of silver have been stood for delivery this year alone, with the vast majority going to industrial users rather than investors. Even Western retail participation is minimal. Most retail sales are driven by inflation pressures rather than strategic positioning. The real movers are industrial giants, sovereign funds, refiners, and large-scale buyers who understand that physical possession is now the primary driver of price. The West's approach contrasts sharply with Asia. While North American and European markets debate volatility and paper manipulation, China and India are aggressively accumulating actual metal, whether through direct mining, importation, or refined stockpiling. By bypassing intermediaries and securing supply directly, they are effectively locking up future availability, leaving Western markets increasingly dependent on secondary sources. This strategy highlights the structural advantage of countries that prioritize physical possession over paper claims. All of these dynamics, industrial demand, backwardation, ETF illiquidity, and Asian accumulation, create a perfect storm for silver. Price charts and technical analysis become secondary to behavioral signals. Who is taking delivery? Who is hoarding? And who is forced to settle in paper contracts versus physical metal? The underlying reality is clear. The silver market is no longer just about trading. It is about survival of supply chains and strategic control over a finite resource. Now, in this final part, we need to confront the most critical reality of today's silver market: margin hikes, bullion bank dynamics, and the end of the fiat illusion. Recent margin increases on COMEX are often portrayed as a measure to control volatility, but in truth, they are just speed bumps, not roadblocks. In a market where industrial users, sovereign funds, and major refiners are taking physical delivery, small margin changes cannot stop the flow of metal. The weakest speculative positions may be eliminated, but the real buyers remain firmly committed, and the physical demand continues to overwhelm the paper market. Margin hikes do not change the structural shortage of deliverable silver. They only highlight the tension between paper contracts and physical reality. One of the most striking developments in recent weeks has been the cannibalization within the bullion banking system. Deutsche Bank, once a major liquidity provider in the metals market, has been forced to deliver massive quantities of gold and silver to JP Morgan and Citibank. Normally, metal flows quietly between banks as part of liquidity management, but this is not routine coordination. It is extraction. Whether the metal is for a house account or a client, it signals a shift in control to the most informed and strategic players who are aggressively positioning for a market dominated by physical demand. December alone saw over 3.7 million ounces of gold and 64.7 million ounces of silver delivered, with January continuing the trend. In just 3 days, more than 424,900 ounces of gold and nearly 18 million ounces of silver changed hands, moving into private custody. This is not retail activity. This is the largest and most sophisticated capital allocation in the history of the market. Asia's role is equally critical. While Western retail investors may sell silver to raise cash amid economic strain, China and India are absorbing tonnages at unprecedented levels. They are not buying paper contracts or ETF shares. They are taking physical possession, securing metals for industrial use, strategic reserves, and sovereignty. This creates a widening gap between paper markets in the West and physical realities in Asia, a structural imbalance that will only intensify. Meanwhile, Western markets remain obsessed with volatility, failing to recognize the fundamental shift toward physical silver dominance. This structural squeeze is compounded by the West's limitations. The United States cannot allow gold and silver to reprice freely, because doing so would expose weaknesses in the Treasury and debt markets. Rising precious metals prices directly undermine confidence in fiat currencies and sovereign debt. Yet the US cannot stop the repricing without delivering metal it does not physically hold. Gold reserves are finite. Silver reserves are essentially non-existent. The only tool has been infinite paper claims. But when those claims are converted into delivery demands, the system cannot keep up. This is not a market crash. This is a regime change, where physical possession dictates value over paper promises. Industrial demand continues to accelerate. EV adoption, solar expansion, AI infrastructure, robotics, defense applications, and chemical catalysis are all consuming silver at rates far above mine production. Most new silver comes as a byproduct of other mining operations, meaning supply is inelastic. China's direct purchases from Peru and Mexico bypass Western markets entirely, siphoning metal away from the global paper market. The result is a market in which industrial necessity and strategic stockpiling dictate price, not speculation. Backwardation remains the clearest warning signal. When spot prices consistently trade above futures, it demonstrates that near-term delivery is more valuable than promises of future metal. This is a neon sign of liquidity stress, highlighting that the system cannot deliver sufficient physical silver to meet real-world demand. Combine this with margin hikes, bullion bank extraction, and Asia's aggressive accumulation, and the picture becomes undeniable. We are witnessing the collapse of the fiat experiment in real time. For viewers, the lesson is clear. Pay attention to behavior, not charts. Watch delivery trends, backwardation signals, and Asia's purchasing patterns. Physical possession is increasingly the measure of security and foresight. ETFs, futures, and paper derivatives can no longer provide certainty. The market has entered a new era, one in which industrial users, sovereign wealth funds, and strategic investors determine value through ownership, not speculation. Silver is no longer just an investment. It is critical infrastructure, a hedge against currency collapse, and a measure of global industrial power. Stay informed, remain vigilant, and recognize that the rules of the game have changed. The fiat system's limitations are exposed, and silver's importance has never been clearer. This is the Gold Rush Reporter reality. Physical silver drives markets. Global demand is relentless, and investors who understand the structural shift will be the ones best positioned in this unprecedented environment.